So in today's video, I'm going to be going over what's the best mortgage for first-time homebuyers in 2025. And we're going to be covering three different topics. Number one, we're going to cover what's the easiest loan to qualify for. Number two, and most importantly, what's the best loan that will give you the most long-term success. And then at the end, I'm going to be covering different first-time homebuyer grants and assistance programs that's available to you now. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I put out educational videos every single week, so make sure you hit that subscribe button so you get notified every time I put a video out. Now let's get into it. So the first thing is understanding how to compare all the different loan options so that you yourself can make an informed decision on which one works best for your situation instead of relying on the bank to make that decision for you. So there's really four different types of loans. We'll get into those later. But number one is you want to compare the loan amount, which is simply the purchase price minus your down payment that equals your loan amount. Then you want to look at the interest rate, and then you want to also compare the payment on each different loan, specifically the mortgage insurance. Now let's go over what all goes into a mortgage payment. Okay, so your mortgage payment consists of five major factors. Number one is going to be the principal. Number two is going to be the interest. Three is going to be your home insurance. Four is your taxes, and five is the mortgage insurance. And the mortgage insurance is going to directly depend on exactly which loan product that you go with. Okay, so the majority of your payment is going towards paying the principal and interest. And in the first 7 years of your loan, the bulk of that is going towards paying your interest up front. Now, your taxes and your home insurance are pretty much the only thing that you can't really control in your mortgage payment. It's really variable, and it depends on the house as far as the taxes and insurance, because you could have two different houses. They're priced the same. In this example, you could have two houses priced at $320 each, and one house could have their tax bill $200 a month. One could have their tax bill at $400 a month, which is going to impact your payment. So it's just something that you must be aware of. And that's why when we're looking at different loan options, because the taxes and home insurance is a variable, we mainly want to look at how your loan affects your principal and interest, and also the mortgage insurance as well. Now let's go over the different types of loan products. Okay, so as far as traditional mortgages, there's four different types of loan products or options, and they each fall under two different categories. Number one, you have your government loan. So this is going to be your VA loan, FHA loan, or USDA loan. And all these loans, basically what they are is they're just backed and insured by the government. Now, VA loans is for those that are active military or a veteran. FHA can be used by pretty much anyone. And then USDA is for those that are buying outside the city limits in a rural area. Now, the second category is going to be your conventional loans. Basically, conventional loans, it's not insured by the government. It's a private sector loan. In this loan, the terms are pretty much based on your strengths and weaknesses. So on a conventional loan, if let's say you have a 800 credit score, you're going to get a lot better loan terms than for someone that has maybe a 680 or a 690 credit score. Now, as far as government loans, these are pretty much standard, almost like a one size fits all. If someone has an 800 credit score, they're going to get pretty much similar loan terms as those that have like a 690 score. Now, when it comes to this video, we're going to be mainly talking about FHA and conventional because these are the most standard and universally used loans. Now, as far as down payment assistance, it's important to understand that down payment assistance is not a separate loan type. It's either going to be used with an FHA or a conventional loan. Now, let's go over what's the easiest loan to qualify for. Okay, so the easiest loan to qualify for is going to be an FHA loan. And the reason is you can get qualified with having a lot lower credit score and having a lot more monthly debt as well. Now, here's the thing. FHA does not lend directly to the public, so you would either have to use a mortgage broker, bank, or direct lender. Pretty much anyone can do an FHA loan. You just can't go to them directly to get a loan by yourself. Okay, so here are some of the basic requirements when it comes to an FHA loan. So as far as your credit score, the minimum credit score is going to be really a 620. Now you're going to see a lot of places advertise that they can go down to a 580 score, sometimes even below that to a 500. And while that might be true, one, you're going to get killed on the rate and fees, and two, if it's below 620, you're going to have to put down a lot larger down payment than the minimum requirement. So really that next major benchmark is going to be a 620. Now, FHA is the most flexible in regards to major credit events. So if you have a bankruptcy, here's the difference between FHA and conventional. The minimum wait time for FHA is 2 years on average, and for conventional, it's about 4 years. Now, if you had a foreclosure, the minimum wait time would be 3 years for an FHA and 7 years for a conventional. So a lot bigger difference between the two. Now, as far as your down payment, the minimum down payment is going to be 3.5%. And this loan can only be used to buy your primary residence, so the house that you're going to be living in. And you need at least a 2-year job history. Now, you don't need to be in the same line of field. You don't even need to have the exact same job for 2 years. You just need to have a history for the past 2 years and no long job gaps. Now, as far as your debt to income, FHA is a lot more lenient on this. So your debt to income is the amount of your income that is going towards your monthly debt. So an FHA loan, they'll allow 50% of your monthly income to go towards your monthly debt. And on a conventional, they allow a lot less. They allow 50%. Now let's go over the pros and cons of an FHA loan. Okay, so here are the pros. Now, number one, it's such an easy loan to refinance later on down the road, as long as the interest rates drop and you're decreasing your payment. They don't need much income documentation. It's very limited underwriting. And number two, it allows you to buy a house, whereas if this product wasn't there, you probably wouldn't be able to qualify with a conventional loan. Now, here are some of the cons. So you cannot buy a fixer-upper, and the reason is this loan type is very strict on the condition that the house is in. So you pretty much have to find a house that's basically move-in ready. And two is going to be the mortgage insurance. Now, this is by far the biggest con of this loan. So let's go into more detail on the mortgage insurance. So when it comes to mortgage insurance, it's really important that you understand how it works, because number one, you're the one that's paying for it. And two, a lot of lenders do not explain this up front because it can be confusing, and a lot of times they don't really understand it themselves. So when it comes to mortgage insurance, there's two ways that you're paying for it. Number one, you're paying for it in an upfront fee. A lot of times it's financed into the loan amount itself. It's a percentage, it's a standard fee, or you can pay for it in cash, but most of the time people finance it. And number two, you also pay for mortgage insurance on a monthly base. Again, it is a percentage and it's a standard fee. So let's go into the math of what exactly the upfront and the monthly mortgage payment is going to cost you. Okay, so when it comes to the upfront mortgage insurance, it is a percentage. It's 1.75% of the loan amount. And how they calculate it is they take your loan amount, multiply it by the 1.75%, and that's going to give you your new loan amount. And when you're comparing different loan options, you're always going to see FHA with this upfront mortgage insurance when it's financed into the loan. You're always going to see a lot higher loan amount than the other types of loans. And this is where people get confused because it's a standard fee. And on a conventional loan, they do not have this upfront mortgage insurance. Now let's go over on a monthly based the mortgage insurance. So it is, again, a standard fee. It doesn't matter if you have a 800 credit score or a 650 credit score. It is 0.55%. And how they calculate it is they take your loan amount, multiply it by 0.55%, and then it gets divided by 12 because there's 12 months in a year. So in this example, your monthly mortgage insurance is going to be $140 a month, and this gets added to your mortgage payment. Now, on an FHA loan, when you're putting down 3.5%, pretty much anything less than 10% or less, this mortgage insurance stays for the life of the loan. The only way to take this off is to refinance into a conventional loan. Now, typically, if you're putting 10% down, normally they will allow you to drop the MI after 10 to 11 years. It just depends on the mortgage servicer. And on a conventional loan, this works a lot differently. Okay, so when it comes to interest rates, generally speaking, FHA offers slightly lower interest rates versus a conventional loan. But here's the thing, that savings is normally offset by the mortgage insurance on an FHA loan. So that's why you don't see everyone just doing an FHA loan. You really need to look at both options, compare them side by side, and see which one works best for your situation. Okay, so when it comes to conventional loans, typically speaking, you need a credit score of at least 680 or above to get good loan terms and a good rate. As far as the down payment, the minimum down payment for your first-time homebuyer is 3%. And if you put down 20% or more, there's going to be no mortgage insurance on this loan at all. You'll need a 2-year job history. Again, it doesn't need to be in the same job or even the same line of field. You just need to have a work history for the past 2 years. And you can buy a house using this loan that's a fixer-upper. They're a lot more relaxed as far as the condition of the home, what it needs to be in, as opposed to a government loan. It needs to be move-in ready. And then mortgage insurance, it's not a standard fee. It's really going to be based on your credit score and your down payment. So the higher your credit score is, the better your mortgage insurance, your monthly mortgage insurance is going to be. Also, the more that you put down, all the way up to 20%, the less your mortgage insurance is going to be. Now let's go over how mortgage insurance works for this type of loan. Okay, so when it comes to mortgage insurance, on a conventional loan, it's not a standard fee. Generally speaking, it's going to be cheaper than it is on an FHA loan if you have a really good credit score. And the beauty about this is you can drop your mortgage insurance. And here's a couple ways that you can drop the mortgage insurance after you close. So it's automatically going to drop once you pay the loan down by 22% and you have 22% of equity in your home. You can also request removal if the value of your home has increased due to the market area, or if you've done renovations that's also increased the value. The value must have increased by 20%. So you must have 20% of equity in the home for them to remove the mortgage insurance. And what they do is you call up your mortgage insurance, they have you submit certain paperwork, and they also have an appraiser come out to reconsider the value of the house. And once that's done, once they've considered the value, you have 20% of equity in the house, they will automatically remove this. This is what I did because I did a lot of work on my home, and within year 4 of owning the home, I dropped my mortgage insurance. Okay, so here's some of the pros and cons of doing a conventional loan. So number 1, like we talked about, it's more flexible and cheaper mortgage insurance. Also, for first-time home buyers, the minimum down payment is 3%, which is going to be the lowest. And it's less restrictive on the type of house you buy and also the condition of the house as well. So you're able to use this loan to buy fixer-uppers. And some of the cons are you really need a good credit score, a good credit history in order for this loan to work. And also, they're more restrictive on how much of your monthly income goes towards your monthly debt. They cap it at 50%, whereas on an FHA loan, you can go a little bit higher. Now let's go over which loan type is going to be best for long-term success. So a conventional loan is really the best loan for long-term success, and the reason is because of the mortgage insurance, like we talked about before. Also, they're more flexible with their loan terms, and also they're more flexible with you after you close on the home with what you want to do with the loan. So you can either drop the mortgage insurance, you can recast the loan, which means if you have a large sum of money you want to apply directly towards the principal, they will recast it and they will recalculate your mortgage payments to a lower amount based on the new principal balance. And you can also drop your escrow account within a certain period of time. You can elect to not pay your property taxes and your home insurance with your mortgage payments. You pay it on by yourself. Now, let's say that conventional is not an option for you to do right now. Here's a good strategy for you to employ. So what you can do is you can use an FHA loan to get into a house, work on your credit, or work on whatever scenario blocked you from being able to use a conventional loan in the first place. And then after that, you can always refinance your FHA loan into a conventional loan and remove that mortgage insurance. Now, let's go over different down payment assistance options that's available for first-time home buyers. Okay, so this first down payment assistance program that I'm going to share with you, it's probably my favorite, and I think it's the best out of all of them. It's actually a national forgivable debt. And here's the thing, the funds are limited. It's available now, and this program won't last forever, but what they do is they give you 3.5% to cover for the down payment, and this is actually an FHA loan. So if you're buying a house that's priced at $450,000, they're going to give you $15,750. And the best thing is it's a forgivable grant starting day 1. So that means that there's no payback required if you end up selling the property within 7 months to a year, whatever the case may be, or if you end up refinancing to get a lot lower rate, you don't have to pay back those funds. Now, here's who qualifies. So number 1 is you must have not owned a home in the last 3 years. So you're a first-time home buyer. Then the credit score, the minimum credit score is a 620. And you must buy the house, must be your primary residence, so you must live in the house for at least 1 year. And here's how to apply. So you would apply through a mortgage broker that has access to this product, like myself. And what you can do, if you're interested in knowing more about this, you can click on the link in my bio, schedule a call, and I'll be in touch. Now let's go over some of the state and county down payment assistance programs. Okay, so as far as the state and county programs, there are so many of these. They're always usually available, and what they do is they cover you for, again, the down payment. So if you're doing a conventional loan, they're going to cover you for 3%. If you're doing an FHA loan, they're going to give you 3.5%. And typically speaking, these are not forgivable. You either have to repay them once you sell the house or refinance. It's going to be a balloon payment, or sometimes they add this onto your monthly mortgage payment for a certain amount of years until you repay back that loan. Now, typically speaking, the minimum credit score is going to be around a 640 plus. You also can only use this program if you're buying primary residence, and there's also going to be area and income restrictions. So it's important that you really understand the fine print before you take on any of these programs. So if you're planning to buy a house, want to know how much your buying power is, or have questions, click on the link in the description, book a call, and I'll see you on the next one.